Good morning. As people trickle in, we'll begin with the ULI impact video.
It's the mission of the Urban Land Institute to shape the future of the built environment for transformative impact. That's what we do at ULI Toronto. Our members work in all aspects of land use.
ULI is a catalyst. It's a catalyst for people who in themselves are thought-provoking, are interesting, they're purposeful, they're engaged, and they want to have an impact on the world.
The Toronto region is definitely a stronger, more robust place because of the championship role that the Urban Land Institute Toronto has played in elevating the status of women in the industry.
Our industry has a responsibility to meaningfully contribute to the social fabric of our communities and to be a climate change leader.
In Toronto, ULI helps deliver climate change and resiliency that is equitable and valuable.
ULI Toronto help mid-career professionals reach the next stage of their careers as city builders.
ULI Toronto is an entry point and a launching pad for our next generation of leaders to find their place in this very complex industry.
ULI Toronto brings global best practices to our city and shows our city's innovations to the world of real estate.
ULI creates really good conversations about important public policy subjects for our members.
It brings leading developers across our city together to wrestle with the crisis of affordability. We need solutions for our industry, tenants, and new home buyers alike.
The ULI network is incredibly effective in bringing in key stakeholders to build solutions to support Black communities.
I'm proud to work alongside ULI in seeking to accelerate accessibility and ensure that our built environments meet everyone's needs for access.
ULI Toronto is well positioned to help the real estate and development industry identify opportunities to meet a generational need to advance truth, justice, and reconciliation. ULI demonstrates the unique power in leveraging the built environment, whether that's private real estate development or public infrastructure, for the benefit of a more competitive and equitable city.
I am so excited as ULI Chair to celebrate these positive solutions that our real estate development community has brought forward for Toronto.
At ULI Toronto, we connect, we inspire, and we lead.
Thank you. That impact video is your invitation to get more involved in the world's most dynamic ULI chapter. You can access things like our global membership directory. You can get involved with ULI through our navigator portal. You can find out about past attendees of events, an amazing network tour. In fact, upcoming attendee lists are available as well. And finally, our Knowledge Finder is an incredible resource if you haven't looked into it, going back decades, actually to the 1940s, of case studies of projects and land use challenges that is hugely valuable to development in the future. You'll also notice that this year ULI is significantly increasing our member-only programming, including more tours and educational opportunities, including the weekly roundup newsletter of industry news stories that you cannot afford to miss, and a single source of all upcoming ULI Toronto events. If you can only open up one ULI email a week, yes, this is true. This is the one. You can get away with just one email a week. That's got to drive membership. And then the next thing is a monthly series featuring senior public officials that we've just launched. Our next breakfast event is going to be this December. Michael Kraljelvik, who's the chair of the Ontario Land Tribunal. In January, next slide, we have Jag Sharma, Deputy City Manager of Development and Growth Services of the City of Toronto. February, Phil Verster, CEO of Metrolinx, and March, Michael Feddison, the brand new CEO of the brand new organization, the Building Ontario Fund, that was like our new bank for Ontario. Huge, important things coming up in the future for members only, and more coming past March. Once again, my name is Richard Joy, Executive Director of ULI Toronto. And once again, welcome to day 3 of our ULI Toronto 5-part lunch webinar series, National Housing Week, Broadening the Affordable Housing Discussion. Before we get into this, as always, we begin with a land acknowledgement. As a Toronto region-based organization, we acknowledge that the land we are meeting on virtually is the traditional territories of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, the Wendat peoples, and is now home to many diverse First Nation, Inuit, and Métis people. We also acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. We are all treaty people. Many of us have come here as settlers, immigrants, and newcomers in this generation or generations past. We'd also like to acknowledge and honor those who've come here involuntarily, particularly descendants from those who've been brought here through enslavement. To better understand the meaning behind this land acknowledgement, and I'm not today going to speak to the work that we do to put meaning behind that land acknowledgement, but we are going to put that into the link that you can see. But there is a lot of things that ULI is doing to drive an exploration of the intersection of truth and reconciliation and real estate and development, and we hope you'll be part of that journey. Today's event and all other ULI programming would not be possible without the support of our annual sponsors. And we'd like to express our gratitude to them for that support. Now more than ever, ULI relies on the support of our sponsors to put on high-quality programs such as today and to drive our mission to shape the future of the built environment for a transformative impact in communities worldwide. To all our sponsors, we say thank you. Okay, let's shift to today's program. Day 3 is Rental, the New Condo. As the condo market stalls, interest in purpose-built rental is rapidly growing, driven by public policy, interest rate reductions, and market forces. Will purpose-built rental become Toronto's dominant building typology once again, fueled by patient capital and long-term returns, or will the condo market rebound to reclaim its former dominance? Perhaps something in between. To lead this discussion, I'm thrilled to hand over the program to my chair, ULI Toronto's chair, Salima Raji, who is also the Chief Executive Officer of the York University Development Corporation. We hope to have time for audience Q&A, and those of you who've been following this program since the beginning of the week know that we sometimes get squeezed for time, but we did get in a few questions yesterday. So please bring your questions forward. They're always very interesting. And panelists, if you're wanting to, you can also answer them directly through your keyboard. And also the last thing note before I hand over to Salima is that all the moderator and speaker bios will be posted in our chat. So with that, over to you, Salima.
Thank you, Richard. Thank you for having me today. And thank you everyone who has joined this webinar. I have the distinct pleasure of leading the conversation, and we are going to get right into it. So if I could ask the panelists to turn on their mics, and I'm going to throw out a question. So please introduce yourself and answer the question. How did we get here? Condos. Why was that the dominant force in our market and markets like Vancouver? And where do you think it's going? We'll start with Lori.
Good day, everybody. Good afternoon, I guess we're at now. I'm Lori Payne, COO and EVP of Development at OGDC. I have the benefit of having the longest title and the longest company name on the slide. In answer to your question, Salima, maybe I'll start with a few numbers that actually Pauline at Zonda shared with me when I started thinking about this question. In 2023, condo represented 70% of housing starts out of the total 20,000, almost 21,000 starts. So still kind of the vast majority of product coming from condo. In 2024 starts, both condo and rental down significantly. Of 13,000 units delivered, 9,000, 73%, a greater proportion actually in condo versus rental, and rental starts down 43% from 2023. So I think kind of as a starting point, we're really seeing a shift in all markets, and that we are feeling incredible pain, as everybody knows, on the condo side of things, but it's really not easy on the rental side either. And so, you know, and your question started with how did we get here? I think one of the other illustrative numbers is this year the industry will deliver about 30,000, just under 30,000 units, about 28,000 units, surpassing the record that was deliveries last year of condo units. Historically, we were delivering kind of 15, 20,000 units a year. So we were in a really weird time that coming out of the boom of 21, 22, to a degree, the first part of 23, that we're absorbing and adjusting to. And until we figure out and adapt and adjust and correct for the what occurred over that small period of time, it's really going to be a period of adjustment.
Thank you, Lori. Stephen, maybe you can introduce yourself and tell us, why do you think the condo market was the dominant form, and maybe give us a little bit of relativity to other markets you might have worked in?
Sure. Stephen Deonkere with Slate Asset Management. I'm the SVP and lead of development. Thank you all for having me join today. Excited to offer a few of my perspectives for whatever there were. How did we get here? I think, I think there's a long series of policy decisions and market trends, some of which came with unintended consequences. And I would say, if there were two major factors that I would point to for why the condo industry was so dominant, I would say it starts several decades ago, and this is a question that we may try to tackle later on, with rent control. And I'm not trying to make a comment on whether that's good or bad policy or whether that should be implemented or not. But I think, as Richard pointed out earlier, rental used to be a much more dominant form of multifamily development in our markets. And rent control did disincentivize that to a certain degree. And then I think we saw a shift. There were other market factors. Developers started to see more of an opportunity and greater returns in condo. And then all of a sudden that began to be fueled by the investor market that came in to actually create this shadow rental market where the condo market for a long time was fulfilling the purpose of a traditional rental market. And, I do think that's unique in the sort of North American and Western European markets. I think we see the condo market as a much bigger component of some of the Eastern markets, perhaps, but Toronto and Vancouver are unique in North America, certainly. And I think those are two of the factors that really fueled that. There's others as well that you could point to. But I think those two trends were unique to Canada and particularly to Vancouver and Toronto.
Jason, did you want to jump in there, introduce yourself and jump in on any other notes on how we got here, having been a participant in the run-up of condos?
Yeah. So Jason Shedletsky, I'm the SVP of investments at Greywood. I spend most of my time focused on buying development sites for purposes of residential development. In the 8 years I've been doing this at Greywood, all of our sites have been predominantly focused as condos. And today we're actually spending time trying to figure out how to convert condos to rental. So this is, a topic that I'm spending a lot of time talking to investors, partners, et cetera. And so, looking back at, much of what Stephen is mentioning there, from 1965 to 1975, we delivered 8,000 units per year of purpose-built rental in the GTA. And that was all driven from incentives. And once those incentives burned off, we didn't see any new purpose-built rental product. If you look at the previous, call it 15, 16 years, condos have supplied 143,000 units of rental product. And over that period of time, the purpose-built rental universe has only increased 27,000 units. So condos have provided almost all of the rental housing required. So why did it happen? Well, it's because condo investors were able to buy units from developers at or below the market value of those units. So people bought units, they were able to flip them for a period of time and make money. And as the profit in selling units declined, you started to see people renting those units out, and that created this rental market. And I think where we are today is that those investors are no longer making money. The value or the price to build the units or to buy the units is too expensive. And we're no longer seeing sufficient condominium sales to build new buildings. So we're in a very interesting environment now, and I'm excited to talk about it with this panel.
So maybe I'll ask you, and then I'll jump over to Tobias to talk about a little bit about rental. But where do you see it going if the driver is gone? Where do we go?
Well, I think we'll get to the conclusion by the end, but there are government incentives available that make rental more feasible than it was historically. There's a number of constraints to that, which we will talk about, capital being one. And I think we will see a lot more rental over this period of time. We're also going to see some normalization or equilibrium in the condominium resale market. And over time, there should be a condominium pre-sale market again. It's just, there's a number of barriers from a market perspective and a government perspective that I think need to be addressed. But yeah, we can talk more about that, I think.
Okay. I'm going to ask a really specific question on that out in a minute. But Tobias, your firm, you'll introduce yourself, but talk to us about why you guys have always participated in rental, and why others hadn't.
Sure. So Tobias Orwell, I'm the SVP of Investments at Tricon Residential, and I work in our Canadian multifamily development business where we build high-rise multifamily here in the city of Toronto. And we haven't always done that. Tricon got its start 30 years ago capitalizing condo developers. Not developing itself, although we did a little bit of that, but sort of providing different sources of capital to other people who were developing condos. And then in about 2016, we dipped our toe into the waters of purpose-built rental development. And quite simply, the reason we started to do that is because we like the fundamentals of the city of Toronto. It kind of seemed a shame to build something and then sell it and not retain ownership of it, and then to watch the growth of the city from 1990 to 2020 and not be able to hold on to some of that real estate. So we started our purpose-built rental program in 2016 with the Selby because of those things, because we liked the long-term outlook and the fundamentals of Toronto. We wanted to hold on to real income-producing real estate throughout that time. And to be honest about it, it wasn't really before 2016 until rents really started to rise to a level in Toronto that made the math pencil for PBR development. I think to answer the question, Salima, that you asked everyone else, I think the reason that condo development has been the dominant form of development over these last 40 years is because that's what made sense economically. Developers put in half the equity. They have certainty on their exit value right away. There's tons of demand for it, tons of incentives helping people buy condos. And the rents were just quite honestly not great 20 years ago. And they're higher these days. And so that really allows some green shoots in the rental development world to have sprouted in the last, I don't know, call it 8-10 years. You're muted, Selena.
Thank you. Those green shoots are ones that I think our colleagues on this panel are all seeing. And can you guys, each of you, just talk about why are you pivoting? Is it really just about the economics? Are there other reasons driving you?
I can jump in. I mean, we're really agnostic to what we deliver. We're builders. We want to deliver housing to a market that we really believe in, whether it's condo or rental. Certainly, I think there's been a long policy understanding that we were unbalanced in terms of delivery of condo versus rental. But I think also picking up on some of the things that Jason was talking about, there are real limits to we are, of course, like everybody else, looking to pivot to rental and tap into some of the programs and ideas that are coming forward to support that, but they're still very, very limited. And there's only a very few number of people who can access them. So as we kind of think about this theme of shifting the balance towards rental, I think one of the real barriers to that is is right now, in our view, all rental needs incentive and support from all three levels of government, and in order to be feasible. And there just isn't enough of that to go around to meet our full demand requirements. Right now, demand is lower because we have so much product online, but come 2027, when we're delivering only 8,000 units, I think is the projection, we're really going to struggle, all of us, to be able to access the capital sources and the incentives that we need to deliver the quantum that the GTA requires in housing.
And so what happens then? Does it require, what has to change in condos for condos to come back to either any one of you?
I can answer that question. I mean, I've purchased a number of pre-sale condos. You know, my first one ended up becoming my home. I chose a building and a location where I wanted to live. I paid what I thought the unit was worth and would be worth at the time of delivery. In order for the condo market to come back, it has to make sense as a home for the person buying it at the time that they have to close on the unit. So long as, you know, we require, you know, let's call them investors, but they're really speculators to finance projects. And we require inordinate amounts of price growth in order for investors to want to buy condos. And today it's hard to see how and why price should increase over the near term. I mean, certainly as a result of supply and demand, you know, being a lack of supply and an abundance of demand, pricing should increase. So that's part of it. And the other part of it is incentives and eliminating controls. So, you know, I've also acquired pre-sale units, which I rent out. On those pre-sale units, I paid HST. I'm doing the exact same thing that a purpose-built rental builder would. However, they're getting a full HST rebate. And we're stigmatizing condo investors and saying, no, they're taking away a unit that someone else could have purchased. But the truth is without the condo investor pre-purchasing the unit, the building wouldn't have got built and we would have no unit. And so I feel I've done my part by helping capitalize buildings. These investments are not great investments. They don't generate inordinate amounts of profit for myself, but I'm very comfortable with this industry and with this investment type, and I manage units. So I don't think I'm going to buy another unit in the near term, but in order for condo to work and for new housing supply to be built, you need to go find other investors like me to attract us to buy units.
And so there's, Stephen, please jump in.
Oh, sure. Yeah, I was going to maybe add just on to turn condo back on. You know, I think the other thing that's maybe a bit unique to Canada, at least compared to the US, is we have a pretty homogenous set of lending institutions, and condo construction financing is very formulaic. You know, I think everybody knows you need the 70 to 75% pre-sales, the thresholds. It's all pretty similar. In the US, I think there's a wider range of lenders with different risk profiles that are willing to structure in different ways. You know, I think in many instances, they don't actually want you to be fully pre-sold because they see that as additional risk. If there's cost escalation, you don't have the opportunity to capture any revenue upside if you're already pre-sold. So I don't know that that's going to shift dramatically anytime soon in the Canadian markets. But I do think perhaps you know, a shift in lending practices for certain projects is something that might be necessary as well.
I'll be a little contrarian if you want, Salima. I just don't see a world where we go from, even today it's 70% condo, and you know, we were probably 90% condo at one stage in the game, to zero. And I don't see that investors will disappear forever. They're feeling a lot of pain right now, and that's going to hurt, and we're going to lose some people in that market. But for 15 or 20 years before then, this, you know, was a sound investment for many, many people and critical to the development process. I mean, there are mez lenders. They are investors in an important part of the process. I'm careful with the term speculators because it's an investment like anything else, and I don't think we should be tainting it necessarily as a bad thing, but it's really critical to capitalizing and getting our projects going. And for a long time, it worked well for people. It has downsides and consequences, and we were far too reliant on it. But I think we can't be overly swayed by a period of time where in 2019, I bought a condo for $800 a square foot as an investment. That investment, it's not stellar at the moment, but it's not doing too badly. If I had bought that condo 2 years later, it would have cost me $13.50 a square foot. Therein, to me, is a big part of the problem, combined with interest rates, is things got way out of control. We all knew it. We all knew it was happening. We all knew the price was too high and that it wasn't affordable. And I think if we can get back to the places where things make a lot more sense, then we'll see the market come back. And that's really going to take digesting all those units that sold well above an affordable price and well above where the market's at today. And that's going to take us a few years for that product to move through the system. And it's going to hurt a few people in the interim, but I do think it'll come back.
Can we talk? Sorry, go ahead. And maybe you can address this. I'm just thinking about the capital stack and just like we've been having this conversation. How is it different in rental and how is it different in condo? And does our market have the capacity to switch that way?
Yeah. Okay. I'll just put one quick point on what Lori's saying is that in the end of the day, a condo is materially cheaper form of housing than a townhouse or a stacked townhouse. So there's ultimately, when comparing on an end price basis, condos will continue to be the most affordable form of housing. And if you can't jump into a $1.2 million house, ultimately the price of a condo will continue to increase and yeah, the market will come back. In terms of the capital stack, I mean, quite simply, condominiums are funded with 70% debt, let's say 15% deposits and 15% equity, plus or minus. Obviously, it changes by project. With a rental project, it's between 25 and 30% equity and 70% debt. So nearly twice as much equity. I mean, and one other thing that I think we were chatting about yesterday on our pre-call is it's not only that we went from 2x the equity for the same project, but all the projects got bigger, right? So we bought a site, 4 years ago, we zoned it for, a 50-story building where when we first bought it, we thought it'd be 35. So we raised sufficient money to build a 35-story building. And now today it's 50 stories. So project, went up 50%, the capital doubled. So that ends up requiring triple the amount of equity to build this, the same site. So, how do you raise all that capital? And then I think, Lori alluded to it earlier, is that once you put in that capital, you build the building, there's no established market today to sell $400 million buildings or $500 million buildings. There's not a sufficient capital market. So my capital's stuck in that project and I can't get it back out to go build a new building in 4 or 5 years without more capital coming into the market.
Can I just pause you just to make sure that our audience is with us? And so, Jason, if I understood you correctly, that a typical condo investor invests in a project, they get their money out on occupancy, and that is a model that is understood by our development community, our condo development community. What you're saying is in a rental space, the capital goes into the project. It doesn't come out unless there's a trade of the actual building, and there's no market for that, you believe, in Canada right now.
Correct. And I mean, you can also refinance it through CMHC financing. But again, that's taking on significant risk with debt and may not result in getting all of your capital back or any profit. And so one of the issues we face in this market is we need to get more capital into the system to fund projects. You need 2 to 3 times as much capital to build a building on the same site as 2 or 3 or 4 years ago. And then once that 2 or 3 times money goes in, we have to find a way to get it out so that developers can recycle it and build more buildings.
Yeah. What about, I don't know if anyone else wants to jump in on that capital question. I mean, Tobias, you talked about how your firm did provide capital for condo developers and then went into the finance space. Did you just attract different types of investors? How did that transition happen?
If you don't mind, I'm going to touch on the condo capitalization piece because I think we glossed over an important piece of the stack, and the deposits. The deposits are cutting developers' equity in half, and the deposits are a subsidy. The deposits are coming at basically 0% interest from people who are making not great investment decisions. Like Lori and Jason, you guys both said the condos that you bought were fine. Like, they didn't lose money, but they weren't home runs in terms of investments. I think that's generally speaking, people see condo prices going up and up and up, but they're highly leveraged acquisitions. They're 80% plus leveraged acquisitions with super low interest rate loans, sometimes insured by the government. And yeah, you make money when you have that much leverage on an asset, but I would say that the risk-adjusted returns from a condo purchaser's perspective are not particularly great, which I think is why you don't see like the CPPs of this world or sovereign capital investing in condo development in Canada, because it's like they make money for sure, but I don't know that they're great risk-adjusted returns. And so anyway, condo developers rationally benefit from that. They can cut their equity in half by leveraging investors who are getting like not a great return on their investment. In terms of Tricon and how we capitalize our projects, and Jason's question about like who's buying them, I think you're right. There is no market for $400 or $500 million multifamily buildings, because the people who had the money to build those in the first place built them because they want to own them forever, i.e. the pension funds. There is like a merchant build type industry in Quebec and British Columbia, other parts of Southern Ontario outside of Toronto, but it's way smaller, obviously. So I think there is an appetite for people to own multifamily that's been newly constructed by someone else, but for the most part, like if you're doing those big buildings, the only people who can write a check for that are also the people who want to be the long-term holders of them. So it's a weird dynamic that we find ourselves in.
Thank you for that. And so we've talked about how we got here. There was really a policy move that the government made that, unlocked this condo space. We have a different set of investors that fund it than rental. What about livability, Tobias? What are the differences? Why would rental be an attractive choice for an end user?
I think when we talk about livability, there's a couple of factors that go into it. I mean, purely physical, the buildings, I don't know, Tricon, we build great product. We put a lot of thought into our amenities, into our community building, into our programming. So that's sort of a softer touch. We build for the long term. So we think about sort of material resilience and building systems for the long term, which is a bit of a different mindset. There's no reason a condo developer can't do that too. That's just sort of a choice that people make. Unit sizing these days is fairly similar. I think it's, smaller units drive revenue. So that's not different between condo and rental. I think when we talk about rentals being bigger, we're sort of lumping in older rentals into that equation. To me, the biggest point about livability is who your landlord is and how responsive they are to maintenance requests. And can you pay your rent in an easy way and not like have to write a physical check and leave it at someone else's address every day? And really like the professionalism of having a proper landlord versus a mom and pop landlord who some of them are good, some of them don't want to be landlords. It's hard. It's hard being a property manager. And it's hard to do it well. So I would say that the biggest difference in livability in my perspective is really like the experience of working with, who's building.
Steve,
you can also add maybe security of tenure. And unfortunately, we've had some negative history in condo rentals about the behavior of those individual landlords. And I suspect it's a very small minority of them, but that your rent can be raised to boot somebody out, or all of those kinds of stories that have come out. There are also stories on the opposite side where those landlords have had difficult times with tenants as well. But I think one of the big attractors to purpose-built rental is you have a lot more security of tenure, and you know, as people are finding it harder to get into home ownership, they're making longer term decisions about renting. And I think that is probably one of the biggest differentiators as well, is that I still do see that we are an ownership driven society, and structurally we're incentivized to move towards ownership. We talked a little bit about the pre-call, and so that also I wonder if we'll start to see a greater shift towards owner occupiers, maybe not the first round, but on turnover in the condo space. As people have fewer choice, they want to get on the property ladder, but they have fewer choices in terms of ground related housing.
Stephen, I think you want to jump in here.
Well, I was mostly going to say that the benefits of being in a Tricon building is you don't have to call Jason's cell phone when your heat pump goes out. But I think that's exactly the point that Tobias and Jason and even Lori to a certain degree are making. You know, I would maybe just add a little bit of context, and I do think our rental offerings have evolved pretty rapidly. I'd say we're still somewhat behind other markets, and we did talk about this yesterday. Both Jason and I came to Toronto or back to Toronto around the similar time in 2011. And when you come from New York or Chicago or other major US markets, it's a pretty established rental offering, and it is about service. And I remember when I first arrived in Toronto, rental was very much for rental buildings were older stock and for those people that couldn't afford to be in a newer condo building. And there weren't many institutional and professionally managed rental buildings. And I think that has started to change. Tricon, GWL, Fitzrovia, there are a number of developers now and owners that have really focused on rental as a service level, as a service and as a lifestyle choice. Lori touched on it before. I think there's still a cultural shift that hasn't fully occurred, where we are still an ownership focused society. But I do think we're starting to shift the tide a little bit on that, particularly with some of the more recent development that we've seen.
Ultimately, I think what I've heard from you guys is that we just need supply. Like, we need supply in all cases. And so can we have the conversation then about policy and what policy levers got us here and what has to happen to get us out of here in either tenure?
So I'll start. And I think it's been in the press a lot about, 30+% taxation on new homes. I personally, money has a fungibility, right? You can invest your money anywhere, including our pension funds and our advisors, and our high net worth individuals. And I personally looked at an investment that was offered through CIBC for a project in New Jersey. And New Jersey doesn't have development charges if you're close to transit, and they don't have sales taxes on construction of a rental apartment building. And for all those reasons, I thought it was a really attractive investment. They're incentivizing the construction of this product. They know that through creating new housing, that ultimately they'll be able to generate revenue through property taxes. But in our market, we're currently double dipping. You're getting taxed on the front end, and then the tenant or the owner is being taxed on the back end. And that's not going to lead to good outcomes. And I think it's partially why condo pricing got so high, is because it had to be. Without the pricing being at whatever it was, $1,500, $1,600, $1,800 a foot, a building will not get built. And so we can't have high pricing being a requirement to building housing. We have to go and incentivize the growth and know that the growth will pay for the necessary infrastructure investments through, an annuity in terms of tax revenue for an infinite period of time.
How much do you think the supply demand, any of you, how much do you think the supply demand imbalance led to the run up in condo prices?
It's everything, isn't it? There's no reason that housing prices, whether for sale prices or rents, should be decoupled from like a normal inflation number, unless there's too many people, too much money looking to buy a scarce resource. So I think it's all in the supply demand imbalance. And I think to prove the opposite side of that, rents are down over the last year. And they're down because there's a huge amount of supply that was delivered over the last year.
Well, I'd also argue that that huge amount of supply was delivered to condo investors who are, I'll use an aggressive word, hemorrhaging money. And if you don't lease your unit up in 1 month, it costs you $3,000-4,000. And so I will take any amount of money to put a tenant in place. So I think you have unsophisticated, desperate landlords that are pulling the rents down. Whereas what we really need is professional landlords with the ability to hold vacancy, to create rents that generate enough value to convince people to go take risks to build the buildings. If we have volatility in the rents, you're not going to result in people making the investment to build rental buildings.
And so what else? What else do we need? We understand the cost-based question on the tax. Are there other incentives? Are there other policy levers that should come forward? Are all of our levels of government are having this conversation? Are they talking to each other? How does it work? Enlighten us.
Well, one of the other things I think is just this idea that more density is more, right? I think we've actually harmed the market by pushing too much density into locations to the point that the capital's not there. So we need money. CMHC, has restrictions on what they can lend in terms of, it must have affordability. And if it doesn't have affordability, then it won't get built. Well, most projects are not economical with affordability. So we have to go and figure out, is there a creative financing tool that can help build buildings, period? It doesn't matter if they're, fully, ESG or green compliant, et cetera, or if they have full affordability.
Let's pause on that because I think you're getting into a lot of details. Let's come back to the policy question. Maybe Lori, Steve, and Tobias jump in, and then we'll hit on some of those points, Jason.
Yeah.
Well, I was really going to echo what Jason was saying is whether it's condo or rental, we need the access to capital through whatever, CMHC is serving a very small number of people right now. And not, the developers on this call can access it. Most can't. And the other incentive programs are really marginal until they get added on to a CMHC situation. And I would say the same is true for the condo side. The incentives might be different, but if we are concerned with the current structure of how we finance condo projects, then we need to have new structures in place. And I think it also involves our lending system and how that's structured so that we can deliver a different kind of product. And maybe I'll leave it there and let somebody else chime in.
Yeah, I can jump in there as well. I think on the incentive side and are the different levels of government coordinating, I would say not enough. No, I'd say we're kind of dipping our toe into starting to play around with some incentives, but there's still a huge disconnect. And, speaking very directly, Toronto's made a few moves, but there's a very tight window and there's conditions around that. And if you talk to Jason, they can't even figure out what the actual development charges are going to be. And Lori's got to hire, a different set of consultants just to calculate that. So there's too much confusion. From my own experiences, just last year, the city of Hamilton dramatically increased development charges because they were focused on the number of building permits that were being pulled and they weren't looking at leading indicators. So there's a huge set of disconnects. It's very fragmented. So each new market needs a whole new set of analysis and thinking to try to figure out, okay, how do we exactly unlock this low margin opportunity where every dollar counts? And then, I'd say the other thing that particularly in the GTA, particularly in Toronto, maybe those that don't work as much outside of this market don't pay as much attention to. Our property taxes are incredibly low by comparison to some of the markets Jason was referencing in the US, where they don't have the development charges, but the property taxes are going to be a little more. So that changes the formula again. And when we talk about incentivizing home ownership versus rental, that factors into it as well. And it's not a popular decision to go raise property taxes, but that starts to change the investment dynamics if you change the burden of that growth cost to a certain degree.
One thing to add is this, like, investors need certainty, right? If we're going to go and build a model, make an investment of $400 or $500 million, you just want to know what's going to come out the other end. And if we can't calculate development charges, because I joke, it requires a PhD, and even once you figure it out, it's going to be wrong.
Maybe we put some context for the audience, which is we can't calculate development charges with the new regulations around development charge relief, that it's not clear. Is that,
It's partially not clear which bylaws apply and then where the discount applies, what items are netted out. And because it depends on the date a permit was put in, there's transition policies that aren't entirely clear, and then there's grandfathering. I mean, as recently as yesterday, Vaughan passed a new development charge reduction where they've effectively gone back to 2018 development charges. So after increasing development charges 41%, they're now going back and saying, wait a minute, let's undo that. But in Vaughan, you also have regional development charges. So you've got two bylaws to deal with. You've got two sets of discounting or rebate parameters. You got two different deferral policies for rental, and it's no one knows the answer, including
I think it's also, Salima, you can't rely on whatever is decided today. We're making decisions today for development charges that are going to be paid 3 years from now if you're acquiring land or you're going through the entitlement process. So, I mean, now I really sound like a developer complaining about these things, but the level of change over the last 3 or 4 or 5 maybe years has been so intensive that it's really hard to keep up. And it also means that the assumptions that went into your original decision to proceed with a project don't hold over time. I would also say that is true for CMHC programs or any other kinds of programs that we depend on. And the one area I have seen a little bit improvement of, but we have a long way to go on, is approval timelines and the reliability of that. I mean, it's a very old song that we keep singing. Now you can get zoned, but you can't get a permit and you can't get through engineering, and all of these things pile on to make the job much more difficult.
Yes.
And really high risk. And I think there were a lot of people who got into the business at a time when things were very, very frothy, who maybe shouldn't have been dealing with the complexity and the scale of projects they were, and we're paying a bit of a price for that as well.
We heard at the Emerging Trends event that ULI hosted last week about our institutional investors making that same comment, that the policy dynamic, the constant change is just keeping them away. And what we've heard in the call today is that we actually need more money coming into the sector. And so that should be a message I think we send loud and clear to our friends in government trying to help, but maybe causing some externalities that they don't realize. So can I ask a final question here? And then we can go to the questions in the chat. We are building rental, some, not very much, but some. And so I heard in different ways that it doesn't pencil. So those that are happening, how are they actually happening? I don't know who's best. Maybe Tobias, you can take a stab at how are you actually doing it?
We haven't. Our most recent construction start was at Kipling Station in Etobicoke, a Housing Now development, Salima, that you were a great help on. And that is a 30% affordable ground lease with the city, CMHC 10-year RCFI financing, which is a very powerful program to have interest rate certainty over 10 years, to have that preferred lending rate, to have that high leverage. You give up you provide 30% affordable housing in return for it, but the math works for the most part in certain locations if your market rate rents are fine with those programs. We love that. We think that's a fantastic model. It's kind of a one size fits all approach, though. It doesn't work in every single instance. So
there's no land value, right? And I think that is like a really important note.
Yep. And then also I think geographical locations matter too, because your market rate rents at the end of the day are what are allowing you to cover your debt service. But when that works, it works beautifully, and we're a huge fan of that. And I think we're probably one of the biggest, if not the biggest user of that or implementer of that program. We haven't started 100% market rate development in 3 years, I think, or haven't purchased one. And it's tough. It's very hard. We're obviously talking in generalities, and there are outliers. Some people have good land bases. Some people have a perfectly designed building. Some people have a perfectly located building. Everyone has different return thresholds. So I think there are rentals that are starting, obviously, but they're sort of perfectly all of the boxes are perfectly checked for them to allow them to start. I think in general, like the normal rental project is very challenged.
Selima,
Yeah,
I
I was gonna.
remember 3 years ago, a bunch of us in the industry going to the city of Toronto saying 16,000 units of rental housing are being canceled when interest rates started to rise. So, you know, I think it's still very tough. And, you know, all of my, you know, I come from the condo world and all of my condo friends are all trying to make rental work. And generally they're saying they can't do it, right? So I think we shouldn't leave people with the impression that we've got it solved. I think we are in a moment of crisis, and out of crisis hopefully comes good positive change. And I think governments are starting to see it and maybe just starting to react. But I think there's a lot of work to be done before we see a mass shift towards rental, not because people don't want to, but because they simply can't make it work.
Yeah. Yeah, I do think though, I think there's an opportunity for, longer term institutional owners of rental that have additional lands. Tobias was touching on this. They have no land basis. They have no leverage on that. They can take their time to get through entitlements. And I think there's real opportunity for those groups as hard costs soften a little bit to kind of turn on the tap there. And if you look at groups like Starlight, or there's a lot of other institutional groups
Shopping
that are
center
sitting on a
owners.
lot of land. Yeah. They've got a lot of potential units in the pipeline. And so I think that there's perhaps a real opportunity for those groups. They don't have the same challenges as the land basis on the condo side, trying to now flip over to the rental side.
So so is rental the new condo? And I'll ask you guys, each of you, rapid fire in the short term and long term. We'll start with Lori.
I will say we need both. Whatever we can build and deliver. I don't think there's enough capacity out there where rental replaces condo. I think there's a world where both exist, and right now neither are existing in a great way, and we really got to deal with that.
Stephen.
I said this yesterday. I said, no, I think condo's the new condo. Condo also always filled a lot of the rental shadow market. I think that's going to be less of a trend, and condo will just be what condo traditionally has been in other markets rather than trying to make up for the rental market.
Tobias.
We live in a city where 50% of people rent and 50% of people own. So if we think that's sort of like what people want in general, and we've been building 95% condo over the last 20 years. No, rental will never be the new condo. I don't think it should be, because 95% of people don't want to rent. We should be building 50-50 if that's sort of what people want. We were not, the condo development share of the pie was way too big for a lot of different reasons. And I don't think we should go back to that for either side of it.
Thank you. And Jason.
I'd say rental is the new rental. We're no longer going to build condos, sell them to investors so they can rent them out. We're going to secure tenure by owning rental buildings with, strong institutional ownerships with strong management. And you're going to see, because of the size of projects in Toronto, you're going to see hybrids like you see in Montreal, where you're going to see a building that's stratified with rental at the bottom, some condo at the top. And we're going to use that to help capitalize. And if you're going to start seeing condos, go back into the neighborhoods, and they're going to complement the low-rise surroundings and create a housing alternative for those who choose to be in a high-rise or in a higher density form. And those units are going to be more livable, larger, and hopefully they're incentivized with lower development charges.
Thank you. We'll take a question here from the audience. I don't know if there's any particular ones you guys want to answer, but there's one here. I don't know, Richard, can I? Yeah, okay. The city of Toronto is looking into becoming developers themselves on the affordable side. How will this affect the development industry? Anyone want to?
I can jump in. I mean, I think that there's, that's great. I don't think that it's going to dramatically impact anything. I think they're going to see the same challenges we've all been talking about. So I think it's great to get more product. I think we all agree there. I don't think that they're going to be able to make an impact enough that would change our day-to-day.
I'd say that both Lori, myself, and Selima have all worked for the city in some shape or form at some point in time. I remember bidding on a Housing Now project 5 years ago, and I think the first shovels are in the ground now. I think there needs to be, private-public partnerships, and I think we just need to really work on the model to improve upon it, and we need to leverage the private market and the incentives to go build more housing.
There's the next question. Oh, please go ahead.
No, it's okay. Keep going.
Yeah. Is there an argument that the condo investor market was an effective mechanism to distribute wealth associated with real estate ownership? If government policies focus only on purpose-built rental buildings, we run the risk of accumulating real estate ownership wealth with a small number of corporations. Does anyone have a response?
I don't know if that I have a direct response to the question, but I think, I don't know, an issue that I have with the discussion around wealth and the value of condos and stuff like that, we just have to, it shouldn't be the case that we think of the place that we live in as an investment vehicle, as a forced savings mechanism, as a way to fund our retirement, because it's a really bad decision to take out a bunch of debt, borrow from your parents, buy a single thing, and count on that for the future, for your retirement, for your kids' university, or anything like that. Like, that's just not a diversified, good investment decision. Like, the housing should just work for you because of where it is and what like life situation you're in at the time, and then go put your money in the ETF or something.
I would also add that, pension funds are large owners and builders of this product, and we are all beneficiaries of pension funds. So our parents are beneficiaries of pension funds. We all contribute to CPP. We can all buy shares in Tricon. You can even buy one share. You can buy half a share. So anybody can own a fractional ownership in this stuff, and so it's actually makes it more equitable because not everyone can go borrow money to buy a condo.
All right, we have, I think, one last question, and it has actually more to do with the livability side of things. And so, how does the integration of universal accessibility feature into the development of new condos and rental units? Is this done in order to retain existing users, attract new tenants and buyers? Is it the context of the aging society that this question is being asked?
I would say right now it's a lot driven by the regulatory environment. So the building code has kind of minimal requirements, but Tobias knows better than others that the CMHC program is increasing the requirements on accessibility in designing units for broader accessibility. Do I think we're there yet? I don't think so. When I was building housing for the public sector, we did build very specialized units for those who had exceptional accessibility needs. It's very expensive. It's difficult to do, but high rise does, or any kind of elevator building does offer some opportunities to explore that. So I think we have a ways to go, but it exists, and we are responding to an increasingly demanding regulatory environment that's forcing us there, just as it's forcing us to green buildings. We just got to set a pace that we can deliver without driving massive costs and increases, because I would say that those kinds of regulations are what caused some of the the green building stuff is great stuff, but it also increases the cost of housing.
Richard has his camera on. That means it's time, but I'm going to ask you one more rapid fire.
Oh, no. Okay, very rapid.
Really good one. Yes or no? Did the federal immigration targets change your outlook on condo and or rental, Jason?
No.
Tobias?
We're working through that right now.
Stephen?
Probably no.
Lori?
I would say no. I think the levels they're working to are not that different to where we started in 2019. So I think it's marginal, but I think we need to be watchful of where it's going.
Over to you, Richard.
I'm going to jump in. I'm going to thank you, Salima, for driving this conversation really, really well. Lori, Stephen, Tobias, Jason, thank you for taking the time to give us a really, really interesting answer to our meta question. Somewhere down the middle seems to be the answer, which is perhaps makes sense. So we'll see. We'll come back to this panel maybe in a year's time to see how things are working out. Tomorrow is Lessons from the USA. It's sort of basically a takeover. We're giving our head office in Washington, D.C., the Twillinger Center, the platform to tell us about how things are happening south of the border. And then finally, Friday, we've got 4 really interesting, sort of almost like a Dragon's Den style of some new ideas that I think will hopefully gain some traction in the future as we attempt to solve for this housing affordability crisis that we're in. I wanted to just add a little footnote on accessibility. We put in the chat there, but watch this space. We are the Secretariat of the Accelerating Accessibility Coalition, and they're about to have their second AGM next week. And Daniels Corporation will be releasing in the coming weeks their blueprint for accessibility that they're going to give to all developers for free, designed in large part by Quadrangle. And this is going to be something that that other developers might use to get ahead of public policy, get ahead of the building code. So I just wanted to flag that for people. Okay, it's 1 o'clock. You've seen the upcoming events, so I won't go into them. We'll say good night. Good night. We'll say good afternoon. Maybe then good night. Thank you very much. See you tomorrow, hopefully. Bye-bye.